Thanks for listening to this week's episode of The Lumber Word. The Lumber Word podcast is dedicated to engaging conversations about the lumber industry, including trading ideas, market trends, and evaluations of overvalued and undervalued assets. Welcome to The Lumber Word. We wish to emphasize
industry
that
veterans
the discussions
Matt Beamer,
and opinions
Greg
expressed
Riley,
in this
and
podcast
Ashley Buckle
are purely for
dissect the world of
informational
commodity
and
lumber
entertainment
each
purposes.
week. We bring
They
you
should not
up-to-date
be considered
insights
as
on
financial
supply,
or investment
demand,
advice.
and market trends.
We
sharing
encourage our listeners
trading
to make their
expertise
own
to benefit
financial decisions,
everyone in the supply
taking into
chain.
account their unique circumstances
Join us for informative and
financial
entertaining
goals,
discussions
and to
that
seek
guarantee
professional
to make you
financial
wiser
advice if
about all
necessary.
things lumber.
Hey everybody, welcome to this week's episode of The Lumber Word, episode number 83. We are recording it on July 10th, 2024. Great to be back. Had some really good feedback last week on the show, and we're looking forward to getting into this one.
Oh, we have great feedback every week, Ashley. Don't you know? I mean, I feel like every week's great. Right?
We do.
Have we had a bad week?
No, I gotta get you back on your Twitter handle going, Greg. Here we get a lot of feedback on X now.
Okay. Yeah. I need to fire that back up.
And I mean, since I'm taking credit for a lot of the stuff that you do because you're not on X seeing it, it'd be good for you to be on it so you could take a little credit where credit's due, if that makes sense.
Yeah. No, that's all good. You know what? I'm happy. You know, you take credit for you can take credit for anything. Anything that's mine is yours. You know, it's kind of like at home when my wife says, "Hey, I need I go, well, why don't you just, why don't you just take that money out of your account?" She goes, "Oh no, I'm not taking it out of my account. That's my money."
I'm not touching that. No doubt. Well, listen, we have a returning guest and back by popular demand because I've Dustin Jalbert from Random Lengths Fast Market, and I hope I got your name right that time, Dustin. Every time I have to ask.
You nail it. I take I take anything from Jalbert to Jalbert, so anything in between I accept. But I generally say
J-bag. No, we're not going to call you that.
Jalbert is generally what I say, but I'm pretty flexible on it. So the French Canadian name, obviously you can take it a lot of different ways. So
we have a big audience in Quebec, so they're going to be happy to have you on this week.
Yeah, sure. My French is not very good though, so they'll be disappointed in that, despite my Quebecois heritage. So, but
and look at your X. Are we supposed to say X or Twitter? Your X handle is 2x4caster, right?
Yes.
Yeah, and great. I love looking at the stuff that you post all the time. Anybody that's not following you need to go 2x4caster and hit that and sign up for Dustin's Twitter.
What is it? 2x4?
2x4caster.
Oh yeah, we follow each other. We do.
Yeah. I follow you, Greg. To Ash's point, you got to tweet more.
I'm not really a tweeter. I kind of lean in on LinkedIn pretty heavily, but I haven't. I need to. There's only so much social media that this old dog can handle. I mean,
understood. Well, there's some, Greg. There's some folks on Twitter /X that they have accounts, but they're kind of lurkers, so they don't tweet.
Yeah.
But they're in the weeds and they're following. So it doesn't sound like
that's like my wife on Instagram. She's just a stalker,
Okay.
And Dustin, there's a little subculture on X too. There's like a lumber group, kind of a little bit, right?
I mean, obviously, I mean, it preceded me because I really only became active on, I've been on Twitter for a while, but I really have only been covering the lumber market for 5-6 years now for Fast Markets. So I work as a business economist for them. And I started on the paper side of our business, but, I became more active in lumber Twitter when things kind of went off right in 2000. And, there's a lot of folks, Stinson Dean's probably the most prolific, lumber tweeter, but there's a lot of folks on there who are participating. So it was, for me, it was a great place to learn, but it was also just interesting to kind of gauge kind of the narratives that were being thrown around the market, some which were accurate, but also sometimes that were maybe, I kind of felt like, the market was being a little led astray in terms of what was happening. But it's just a fascinating space to kind of network in and bounce information around it.
there's a psychological effect. I'm trying to think of, it's got a name for it. When people in an industry read news stories about their industry, they always shake their head because if somebody outside of the industry writes it, right, it never seems right. But then if you read any other news, you think it's correct, right? I'm trying to think. Anyway, that's interesting. But first of all, back to like Stinson, he's at Lumber Trading. Is that his?
Yeah,
handle?
I believe that's his handle, at Lumber Trading.
And look,
so,
he promoted us in the show really well last week. The guy does a great job. He was just on Odd Lots again last week, the Odd Lots podcast, which was really cool. I got to follow that a little bit more. So
yeah, I was really impressed with the I guess you call the commentators that were interviewing their level of understanding of some of the nuances and the housing, and because so many times you listen to people that, hey, that person has no idea what they're talking about.
Yeah,
Of course, people say that about me too. So I don't know.
No, Tracy and Joe, at Bloomberg, that they've been doing. I don't know how long Odd Lots has been a thing, but with particularly with everything that's been going on with the supply chain, right, since the beginning of the pandemic, they've done so many different supply chain episodes in so many different industries that they really have got a lot of color and information on how these kind of bullwhip effects work. And they've done a lot of stuff in the real estate space in particular, from the actual home builders down to building, the LBM space to obviously the lumber space. I think that was Stinson, I think his third appearance. So,
he did a great job.
Yeah, absolutely.
Yeah, no doubt about it. So I saw you put something out. I love the word Zeitgeist also. And I saw you put that out last week and I highlighted that. I'm like, this podcast, we're going to find out about the zeitgeist of the lumber market. I think zeitgeist is the overall feel or temperature of something, right? Is that like, am I following that correctly? And
yeah, I think so.
That's a big word. That's a big word.
Yeah. I think the way I used it is in terms of, it was sort of going to sort of be representative of the zeitgeist of the macro economy. Like it was just come on sort of everyone's mind. And, a week later we had, whatever, I don't know how many sort of articles on lumber in kind of the mainstream press and that appeared in an Odd Lots episode. And so everyone's paying attention to it again. And it really does kind of reflect the feel of the broader economy too. So.
Absolutely. And it's funny, like there was about 6 articles, podcasts last week, and historically, that's either the bottom or the top of a market.
Yeah,
so
sure. Yeah,
we'll see what happens. What Greg's always promoted in 4 or 5 phone calls today. Ash, Greg, what are we doing in this market? Where are we going? And it's one of those markets where we're really not going anywhere right now. There's some liquidity. If you want to get cheap, a lot of people keep quoting. I see the same quote by 5 different people sometimes right now. So the market has been tough. I mean, basically down for over 3 months without any type of even relief rally on any species. So we're trying to figure out, I could go through all the spruce, Doug fir and all that in the lumber prices, but I don't think we really have to hit on that too much. Greg, what's your thought? I mean, maybe just touch on what you see going on.
I really look at the market's been probably a steady down for almost 4 months now. I mean, I feel like in general, losing some downside momentum, whether it's just, fatigue or because we just have gotten to such low numbers and there is less European lumber coming in. There are a number of, curtailments, whether announced or unannounced, summer shutdowns. So, the supply has shown, and maybe we can talk a little bit, Dustin, a little bit about what you have in terms of production numbers. But, and so the market's kind of flattened out here, but a flat market is a down market. And the longer it's flatter, the more down it feels. It's just, like you said, Ash, we've had a bunch of calls and I'm like, hey, what is it? Drip, drip, drip. It's Chinese torture at this point.
Yeah, good question. Consumption and demand. A few of the things that I see are we got smaller houses coming out. I saw Lance put something out about 900 square foot homes being built in the Fort Worth market by some people. Multifamily has been down almost 50% or greater, especially in the areas in the South where Southern Pine is produced. Repair and remodel, we think, is down from what we can garner from everywhere. Home listings are up from what we see year over year. We're back to home listings up a little bit. Interest rates, right? For the most part, everybody's waiting for rates to come down. But if you look at some of the big builders out there, you're already seeing 5% interest rates at a lot of these builders, right? So, I mean, everything is happening this year. We all expected maybe one leg of the stool to be a little weak, but like everything is kind of, single family is okay right now. When you were on last time, it was great. You chatted about multifamily lumber, less used in a start there than single family, right? And at that point, when we talked a few months ago, it had kind of done well leveling off. It didn't really eat into the total consumption because single family was up, multifamily to kind of mitigate that multifamily being down.
Right.
And repair and remodel was still okay at that point. Where are we now on that?
Yeah, I mean, I think the key thing that's changed now, right, is that single family piece has really lost momentum. When you look at, single family housing starts through May, we're sub a million on a seasonally adjusted basis. I have to look exactly where we are, but it's, when you look at it on a year over year basis, we're actually now down in May. It's the first month we've been down this year. We're still year to date, we're still up. But, you think about season, that number is seasonally adjusted, right? So when you think about the non-seasonally adjusted numbers, it's really from, April into, let's call it October or so, when that's peak seasonal construction activity, right? So really the kind of middle of the year matters more from a volume perspective. So if we're losing momentum on a seasonally adjusted basis in the middle of the year, like, the year's more or less over now from a volume perspective, right? And that's what the market is feeling. And I think that is what is sort of kind of alarming to me is like the pricing environment in peak seasonal demand. Let's call repair and remodeling the peak is, around May, June, and it's a little bit later for new construction. There's no juice in the market, right? So, I mean, that is just a bad sign. And I think, again, what has changed from our last conversation? It's that single family piece is losing momentum. And I think the market is just, in a lot of ways, recognizing that the year's kind of over here. Like, we have to kind of wait and see what things are going to look like when the Fed cuts rates into 2025. So it's just, that's the big piece that's changed. I mean, we felt that single family was going to lose momentum in the middle of the year. That was part of our forecast, but it has lost momentum a lot faster than we anticipated.
What are you forecasting 2024 housing starts to be in total?
So I think next year we're calling for it to be
2024 this year.
Oh, 24. So I think we're at like a 137 or something in that ballpark.
137?
Yeah, 135 to 14 range is what we're calling for both single family and multifamily.
Which would be basically that would be flat with last year?
That would be, here, let me check the numbers offhand here. So I'll pull them right up. So
that seems like a big number to me.
Well, it could be, and you could be right. So I'll pull them up here so I have them. So right now, as of our latest forecast, so for 2024, we're calling for a 136, and that's down from 4 to 5% from last year. So that's what we're calling for.
And that's basically with a flattish single family and multifamily down. Do you think multifamily, if it's down almost 50% for the first 5 months of the year, do you think that number will, at the end of the year, will be better than that? Or will it still be down that much on a year over year basis?
Let's look. I'll just pull it up here on my numbers. I don't know it offhand, but let me just see it.
No, I don't want you. Dustin, I want you to dig in on it, man. I want you to dig in.
I'm one of those economists. I'm not a guy who remembers the numbers offhand. I remember the general trends. So let me just look at the numbers real quick here.
What I get accused of is just making them up.
No. You're right. So, basically what we're saying from here is the multifamily side. Let me just give you the seasonally adjusted numbers. We think from here, they're going to sort of bottom out on a seasonally adjusted basis. So let's call it between 300 and maybe 350,000 units seasonally adjusted. So we kind of feel like the bottom in starts is in. when you look at that year over year, sequentially, it will start to improve. And you're right. It's in the, 30, 40, 50%, maybe a little more year over year that we're trending right now. But assuming our forecast is somewhat in the ballpark, it's going to be more like 10 to 20%, by the end of the year. So it is going to improve year over year sequentially, but down is still when you're down that much.
We're down 40% for the first 5 months of the year. If we end up being down, 30%, or 27%, that's still a big decrease. But
a lot of that is base effect too, right? So we're calling it kind of flat, but it's really just because the 12 months back number is falling. So it's not so much that we're improving in real time. We're just saying, okay, well, the year over year comparison is getting better, but it's not like we're seeing a ton of momentum in multifamily picking up.
Right.
So.
I mean, because actually I show, the first 5 months of the year, single families up 18% from last year for 5 months. And that's probably not going to be up. I just saw a thing for Lennar is offering 4.5% mortgages in Chicagoland for move-in ready homes that you purchase between now and the end of July and you close by the end of August.
So can I ask, who wears that mortgage then? Who writes
Lennar
that?
does.
So they write it, they hold it then?
Yeah. So it's through their mortgage subsidiary.
Yeah, they're basically paying the points for you, right? That's essentially what they're doing, essentially. So
that means
they have a lower cost of capital and
they take it out of their margin effectively, right?
For sure.
But if it helps them clear the market so they can move volume, and
in lieu
by
of
the
cutting
way,
the price of the home, they subsidize it through the lower mortgage rate, right?
Which in theory is cutting the price of the home.
Yes, right.
In theory, but I mean, at least the top line number is not being cut. And by the way, their private and small builder competition can't do that. So they're basically buying market share that way, right?
And that's what the big builders are doing versus the small builders. They don't have that same option.
So I mean, this is actually strangely, I don't suspect it's going to last this way forever, but it is a little bit of this like Goldilocks period for the bigger public builders because, to Greg's point, they can finance that those rate buy downs much cheaper than, obviously, a smaller builder that's, on a construction loan, right? Floating rate construction loan or whatever,
Sure.
right? So it's just a completely different dynamic. This kind of higher-ish rate environment is sort of helping them. It's just a matter of whether their building material costs and land costs will continue to cooperate where they keep these high margins, right? So.
Well, let's jump over to, we just talked about the demand side. Let's talk about the supply side now a little bit. Talking to one of my buddies up in Vancouver this morning, and he said one of the big mills he talks to estimated there's 1 billion extra board feet of production hanging out in the system right now, right? And I would have mentioned his name, but I didn't ask him if it was okay to mention it yet. And he had a great point. And he's a really good golfer, though. I'll say that. He basically said, think about it. That's only a week's production, right? In a way of North American production, roughly.
Yeah,
right?
Yeah, 52, 53 billion board foot, or maybe a little more. Yeah,
and we were talking, and it's interesting. A lot of people I talk to that usually have cars rolling, big traders and all that, don't have cars rolling or only keeping their own inventory. So the theory there is they think that this inventory will get chewed through. Let's talk about it. We're going into summer shutdowns at some of the eastern mills. We have seen some attrition in production, so to speak, with mills taking off some shifts, et cetera. BC certainly is a lot less of the production, obviously now, since we're off so many billion board feet over the last few years. But the thing keeps coming back in the South. They keep pumping it out in an area that is just not consuming as much as they're making. Prices are just telling us that. You said the actual utilization rates were down. Have those changed at all? Are we still seeing?
What's your latest production numbers that you have for the regions, Dustin?
I honestly, I didn't check these before I jumped on here, but for North America as a total, I mean, we're down 2-3% year to date. And the data is pretty lagged, unfortunately, that we depend on between the StatsCan data and, StatsCan and the WWPA data. Glad we have it, but it is kind of slow. But, year to date, if you want to call it through April, May-ish, we're down low single digits. And, I think, the region that is dragging down more is Southern Yellow Pine. I think production is still down in that region. I think it's improved since we last talked about that market. It's actually, there were some big upward revisions to the numbers too, but I think they're still trending down in the South. And, I think the Pacific Northwest is maybe more flattish to up. And I think the Canadian production is up as well, which is kind of interesting. I think that's going to change as we get into the end of the year, because we do have more closure announcements that are just kind of starting to kind of actually materialize, even though they're announced in, let's say, Q1. You got to chew through that log deck, and now it's maybe just happening in Q2, Q3
Well,
here.
I think one of the things is, Eastern Canadian production and shipments were up in the early part of this year because they had cheaper fiber with buying the fire timber, which has caused so many issues across in the markets.
Are we through that yet?
What's that?
Are we through that yet?
It sounds like most people are pretty much through that, and so that's going to affect log costs. So like they kind of have like on the cost side. We've been chirping for months that we're below the cost of production, and obviously we're not enough below the cost of production to cut more production yet.
Yeah. It's hard because, having that number, we have our estimates, that we make, and it's hard to know in real time because, there's so many factors that go into those break evens, right? But BC Interior in the, 400 to 450 per thousand range on variable production, or if you're looking at cash costs, somewhere in that range seems like where we're probably knocking around. So like
you're saying 400 to 450 FOB.
FOB, yeah, mill,
Okay.
FOB mill, FOB mill. So and cash
mill
right now, I think
mill nets now are sub 300.
To me, they're deeply negative. Now, there's this kind of circularity, right? Because the stumpage systems in Canada, it's sort of lagged with the lumber prices, right? So some markets like Alberta are very reactive in terms of the stumpage prices, while in BC it is much more lagged. It takes, better part of a year for those stumpage rates to adjust. The stumpage rates are adjusting down in BC because, to Greg's point, we've been on this long downward path in prices here. The problem is it's not just a stumpage rate story. There's harvest and delivery costs, which are, probably moving down, but they're not moving down at the same, sort of percentage sort of pace that the log costs are, right? So, it's still a very challenging operating environment in BC to sort of harvest with all the regulations, with all the sort of challenges they face. Sort of you have to go deeper into the stands to sort of get that marginal stick of fiber. So, the stumpage prices are coming down, but and also, by the way, your converting costs, everything else for your converting costs, your labor, all the other factors, your energy, all that is up. So it's just, the cost structure of the industry is probably up, 10, 15, 20% from pre-pandemic levels. And we're, sub 330 per thousand FOB 2x4 for Western SPF. That's just not sustained. In the medium run, that's not a sustainable equilibrium. But in the short run, no one cares about your break evens, right? It's whatever it takes for that inventory to clear.
So hearing this on the supply and the demand side, price is still telling us there's not enough done yet, right? What's going to be the ultimate response? Is it a waiting game here still, or do people still have hope that there's going to be more come back? Or, as Greg said, we're probably below the cost of production, but we're not at shutdown cost yet. What's going to happen in the South? Are these mills? Are they going to have to take some mills down for an extended period of time? How much, if you just had to spitball, and I know this is, how much are we overproducing based on the lag that we see in the demand out there?
So, the way I think of it, Ash, is it's not so much the production, because I'm sure the production is it's probably a little outpacing demand, right? So like
generally it's pretty close though.
Yeah. So but it's probably a little outpacing, and that's why we have the inventory buildup that's probably out there. I don't know if it's a billion board feet excess. It's hard to know, but the market is telling us there's too much inventory out there. Just looking at prices,
it only needs to be like one truckload. That's right. Too much. Yeah. One truckload too much is too much.
But I do think, when I think about the market, I think about the capacity base, right? So the industry operating rates are probably in the mid to high 70s right now. So let's call it 77, 78%. To, a balanced market in lumber traditionally would be like 82, 83%. So, I mean, there's both demand and supply levers there, right? But like, even if we have a big jump in demand next year, which we're pretty optimistic on demand next year, like we think we'll probably grow 2 to 3, 2, maybe 3 billion board feet of demand. But even how
does that break out? I mean, if we're forecasting 1,337,000 to 1,000,000, like, 1,350,000, 1,007,000, which is, down from 1,420,000 in 2023. What's the 2025 forecast?
Sorry, when are you talking for housing starts specifically? Yeah.
Yep.
So I'll pull it up because I just want to get the right number. And like I said, I think we're in the mid 1.4s, but let me just check it. Oh, yeah. So next year, we're actually at a 1.5 next year. And that breakdown is single family. We are assuming about 1.1 million starts. So this year we're saying 2024 is about 1 million. So we're up about 100,000 starts next year. And then multifamily, we're up to going from 330,000 starts this year to almost just a hair below 400,000 starts next year. And repair and remodeling, up low single digits, maybe 2 to 3%, next year. So that's kind of where that colors, and industrial markets rebounding too. So, but yeah, just in terms of, just that recovery that we're calling for, that's barely going to get us at like 80% operating rates, assuming a flat capacity growth. So just to get us back to balance, there's another 2 to 3% of the industry capacity base that probably needs to come out that hasn't even been announced, just to get us back to balance next year.
I think one interesting thing, I had a couple questions on X from some people this week. If you go to your local lumber yard and you're a remodeler, you want to throw a bunch of wood in the back of your pickup truck and go home and bang something out that you've been yelled at about not doing, right? Have the prices here's what I love doing, Dustin. I go into Random Lengths, and I love on Random where I look at so last week what I did is I looked at all the delivered prices, 7/16 OSB all over North America, right?
Yeah.
And then I did a cross reference checked out like 7 states and what some of the big boxes were pricing on 7/16 because it's the most homogeneous commodity item there is.
Yeah.
And a week ago, I didn't see it yet adjust, but it's starting to now, right? And generally, when these news stories come out, it's just starting. But there's like a 3-month lag when lumbers come off before they show up at a retail yard, right?
I think I was going to say it's at least a couple months, and I'm sure yard by yard it varies. I mean, that's generally kind of my rule of thumb. I'm in a lot of the big box stores myself as a homeowner, and doing I live in a 120-year-old house in Massachusetts, so there's a lot of R&R happening at the Jalbert household. So I do try to pay attention to, a lot of the commodity items too. And certainly, you go through the home centers, they don't move that rapidly. And it usually takes a pretty good move in the wholesale price or what Random Lengths reports, the mill to wholesale price for that to flow through. Right.
And one of the interesting things is with the old Econ 101 elasticity or inelasticity, I don't think at this point lower prices are going to cause any demand type of reaction, in my opinion.
Yeah, I mean,
maybe I'm wrong on that.
Again, you go look at a 8-foot 2x4 SPF, at least around here in the greater Boston area, and I think they're knocking around $3.50 per stick. If it goes sub $3, is that going to your point? Is that going to move the needle on
which is like
projects?
$600 1,000, right?
Yeah.
And the actual delivered price in the wholesale market is like $350, right?
Right. Yeah. So I mean, is that especially for a product that low price, is it going to move the needle? I mean, I especially when we've already had huge decreases in prices over the last year or two from the top of the market, right? So if it's not moving the needle now, from that, there's probably something else going on, right? And I think it's just broadly, I think the consumer, I don't think is in a terrible spot in the US, but I think discretionary spending is getting pressured. And so, those home projects, people, because I actually, our outlook for repair and remodeling demand for lumber this year, I was thinking it would actually trend a little bit above the broader repair and remodeling market, because I said, of all the commodities out there, the wood products markets have actually corrected the most compared to other building materials. So like, if there is some elasticity of demand and people are having to be choosy on projects, maybe they'll do that home edition or that deck edition.
Maybe I'm wrong on that. Maybe it will have a reaction.
Well, like my biggest thing on repair and remodel is that when I look at existing home sales at a record low, and I think about that, I go, what spurs a lot of R&R work? Well,
moving.
Like, you're going to sell your house, you do stuff to like fix it up. And you buy a new house, and what's the first thing you do when you buy that home is you've got a project, because everything has work done. And so I think that's the bigger impact on it. In terms of your point, Dustin, I mean, when we think back of like what happened during the pandemic, people would say, wow, there's a real shortage of lumber. No, there's no shortage of lumber. We allocated supply by price. Everybody that wanted lumber got as much lumber as they wanted. They paid for it. The people that didn't want to pay the price said they couldn't get it, but they could get it. Whereas in other building materials, you had big major customers hoarding that product, and it really wasn't available to other people, right? I mean, there was it was 6, 8, 10, 12 weeks, people, but those because those prices didn't allocate supply in a free market, they allocated on some other model, like the biggest guy got as much as they wanted and the little guys didn't get anything.
Yeah, I mean, it was literally on allocation, right? Like those products, but and like you said, it's just like, okay, there for whatever reason there's a shortage, and like you said, the big players probably got the bigger allocations. So it's no, I mean, I think there were real. I will say this: I think in the first 12 months or so, I do think there really were real material production shortages in the dimensional lumber market, because mills curtailed super aggressively at the outset of the pandemic, thinking that demand was going to be down, right? So like they, sent shifts home, and obviously, everyone was wrong about that, and so demand is up. And between all the other competing industries in the goods markets, when you had this huge surge in goods demand from the pivot from services to goods, I think a lot of those workers didn't come back on the job super quickly. It took 12 months to normalize headcounts. And then obviously you add on all the other COVID related, like people getting sick on the job and shifts having to be sent home or distribution issues, all that. So I think those were real in the first 12 months. But to your point, I think the market changed, let's call it mid to 2021 forward, when really demand started turning over, Demand started turning over in the R&R market, even as new construction kind of started picking up. So then it became a little bit more of there was availability out there. It's just whether you would pay for it and how long that would last, that kind of surge pricing environment. So
one thing we have coming up in the next month or so, and everybody in our industry talks about it, but I don't really know if they know exactly, the cross-border quota/duty going on is supposed to increase. How can we make that cliff note so people understand what's going on?
Yeah, so the Department of Commerce. So right now, historically speaking, the lumber industry between the U.S. and Canada has had basically this ongoing, fairly like formalized dispute since the early 1980s, and on and off again. There's been basically managed trade agreements between the U.S. and Canada, which you'll hear called softwood lumber agreements, the SLAs. The last SLA expired, I think it was in 2015. It expired. There was like a year kind of period where neither side of the border was allowed to sort of make any sort of trade action. Then 2017, we kicked off where the U.S. Department of Commerce launched a new round of anti-dumping and countervailing duties against Canadian lumber. And the basic premise there is that Canadian lumber is subsidized and dumped into the U.S. market. That's sort of the legal sort of matter at hand. The Department of Commerce carries out this annual review process every year, and they basically go back retrospectively and look at basically 2 years back what the conditions were, looking at lumber prices relative to production costs and log costs, all these things, and make an assessment of whether lumber from Canada was dumped into the U.S. market and log costs were subsidized. So this year, right now, the average duty, so it varies by producer, but for the average producer, I think it's around 8% right now, the duty levels combined for anti-dumping and countervailing duties. The preliminary rate was announced early this year. This always sort of happens. Always early in the year, they get a preliminary number. There's a period of sort of response, and then the finalized numbers get set and put on the Federal Register in July or August. So we're a couple of weeks away. Those new duties are going to jump to almost, I think it's 13.86%. We don't know what the finalized number will be, but it probably will land somewhere in that ballpark. So that, I just guess the way to think of it, right? Those Canadian producers pay those duties up front when they ship across the border. So although on their balance sheets, technically, if there's an agreement, some of that money at the Department of Commerce may go back to the Canadian mills. In the near term, it basically adds to their cash costs of production to deliver to the U.S. market. And that's how we look at it from a modeling perspective. That's an extra, 5, 6, 7 percentage points on their marginal cost of production going into the U.S. market. And so that's bad news for Canadian producers right when the market is obviously very bad right now, right? So, and those finalized numbers probably won't change from the preliminary assessments. There was a international trade court sort of order recently for the Department of Commerce to review the assessments on Canadian lumber, and that there are things from a methodology perspective they didn't carry out correctly. But this always happens. This is an ongoing thing. It's sort of this cat and mouse thing that's ongoing, and it will go back and forth. It doesn't really change the trajectory probably of where things are going in the near term. So not good news. Not good news for the Canadian mills, unfortunately.
I think from a market perspective, it just it raises costs. In the short term, there's an incentive for mills to reduce their dressed inventory because whatever they ship prior to that, they're saving that 5 or 6%. But we're just the real question is, we're below the cost of production.
Right.
How close are we to the shutdown number? And
right.
What is that? Does this push us into the shutdown number? If we're going to look at, hey, the mill nets now are going to be $250, $270 a thousand in BC. BC's cut so much wood that they're a marginal producer now. Twice as much lumber is produced in the rest of Canada, and another 50% more than that is produced in the southern U.S.
Right.
So,
exactly.
What happens in those markets have a much bigger impact than what happens in BC anymore.
Well, true, but it is still that, like you said, it is still, when you think about the cost curve, they still are at the top of the cost curve. So, in theory, that is where those production cuts should come first, right? And it does sort of set, if demand does increase next year, that is going to kind of set where in theory anyway, basic kind of macroeconomic theory, where we should go up the curve. So, it still does matter. But I think going back to your original point, Greg, I think to me, I shouldn't say that duties are irrelevant, but we're so below at least what theoretical cash costs are right now that you would think there would be more. I think there are curtailments that are probably happening more quietly. It would not shock me, though, if when the finalized duties are announced, we get maybe another wave of closure announcements. We'll see. But to your point, we're so deep right now that mills are bleeding cash. It's
and historically, what ends up happening is, as demand starts actually getting a little bit better, and then they keep cutting production, which is why you get these outsized market moves after the fact. I tell you right now, there's nobody right now out there that thinks that lumber prices can go up by 50 or 100% in the back half of this year. Nobody. There's nobody out there.
Yeah, and we were honestly,
you know what? So I think that's going to happen. Okay, there, I said it.
Well, here I do think there is something to this idea that there's a bullwhip effect that's forming, right? Because when we overshoot this much, and I fundamentals are not awesome right now, but you hear a lot of discussion, and I think Ash, we've talked about this before too. There's so much discussion about. This feels as bad as it was back in the global financial crisis. Just from a demand perspective, demand is not off by tens of billions of board feet like it was over a 5-year period, we're down, maybe, from the peak of the market, 4, 5, 6% in terms of volume, which is, that's a big move if supplies continue to increase. But mid to high 70s on operating rates it's not great, but it's also not, you give that a few years and the market is going to be balanced and maybe even tight again.
We're also building 2 million homes back then and producing and consuming 75 billion board feet of lumber in North America.
Sure, but the capacity base was also larger. We lost, I think, 20 to 30% of the capacity base over that 5-year period. So, we still haven't recovered in terms of the industry's productive capacity is not, I'd have to go look at our chart, the latest chart, but I still think we're still about 10 billion board feet below the the 2000, let's call it 2006, 2007 peak. So the productive capacity in the industry is much lower than it was during we're not building as many homes, but the industry supply base is much less too. So, and that's why, it is a bit of a theoretical number because it's, capacity is a bit of a squishy number, especially for lumber. There's a lot of flexibility with adding shifts and how much of those smaller mills, their true capacities, that's hard to measure. But that's why we kind of look at it from that market balance approach. If we're in the mid to high, 70s on operating rates or the demand to capacity ratio, you get a decent demand recovery the next year or two, we'll probably be back to balance. And if we overshoot on the supply side too much, maybe it happens sooner,
So to wrap it up, let's just real quick, you have a new dashboard on Fastmarkets on Random Lengths.
Yeah, I did. So I tweeted this out, and admittedly, I'm a relatively new user, but our Fastmarkets is rolling out to the new Random Lengths customers, existing Random Lengths customers should be able to access this new dashboard application where you can basically get your Random Lengths prices, add them in your own kind of bespoke custom dashboards, the CME futures prices there. So it's a pretty cool application. There's going to be a lot of other features coming soon, in terms of some of our own analytics. Like if you have a forecast, price forecast that myself or my colleague Jennifer Coskren produces, or Emerson Parity, if you look at non-structural panels, that will appear in your dashboard. So there's a lot of cool applications. And if you have cross commodity interests, I was looking at framing lumber and OSB prices versus rebar and steel beams and kind of looking at those trends, and that's sort of other areas in the commodity space our teams cover, and the steel and kind of steel. We have steel, battery, raw materials, ag. So it's a pretty cool platform. You'll probably see me tweeting a few more of those sort of snapshots of my own dashboard. But I guess if folks are interested in that or seeing kind of notifications in their inbox and they have questions about it, let us know, and they want to sort of start playing around in that. So
it sounds good. I can't wait to bang around in that thing, see what it looks like, and give you some feedback on it. Well, listen, Dustin, man, appreciate having you on this week. Make sure you follow Dustin at 2x4caster and check out Fastmarkets and Random Lengths. What's the website? I didn't even know. What's the website to check out for you guys?
Yeah, you could just go to fastmarkets.com and you can kind of navigate around there. So that will kind of get you where you need to go within the wood products side. So
sounds good.
Always good to have you, Dustin, man. Take care.
Yeah,
all right, guys.
Dustin, Greg, thanks again. You guys produce a great show, so always a pleasure to be on here. So
you bet.
Right on.
Talk to you soon.
Man. Yeah.
Thanks for listening to this week's episode of The Lumber Word. The Lumber Word podcast is dedicated to engaging conversations about the lumber industry, including trading ideas, market trends, and evaluations of overvalued and undervalued assets. We wish to emphasize that the discussions and opinions expressed in this podcast are purely for informational and entertainment purposes. They should not be considered as financial or investment advice. We encourage our listeners to make their own financial decisions, taking into account their unique circumstances and financial goals, and to seek professional financial advice if necessary.